Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is November 5th, 2017 edition of Market Outlook. So as you can see, we got a little bit of a deterioration in our big view gauges here. Nothing to be concerned about. We're still in overall bullish mode. Let's get into the details. So the first thing to show is that obviously all of our trends are pretty well intact. Can't really argue with that whatsoever. So as you can see, we're above the 10-day moving average. Everything is stacked and sloped. You got a similar scenario closing at all-time new highs in NASDAQ, the S&P, the Dow. The one thing that's been lagging is our small caps. That's IWM. It was actually down for the week, and so it was down, just a small fraction, but nonetheless, it was down for the week. Now, as you can see, our momentum indicators all are looking pretty positive, considering where we closed in terms of positive direction. So, in terms of critical levels, if in fact the Dow breaks under the 10-day moving average, the key point here is 233 in DIA. You definitely want to see that hold on a closing basis. That would be a close under the 10-day moving average and all of this compression range in here as well. Now, in terms of the Qs, this is the most extended, and you've got the most amount of risk to the downside. So this is a bit tougher to call, but clearly somewhere under the 150 level would take out the 10-day moving average, and that big spike up after the earnings reports from those FANG stocks. Now, the key level to watch in the S&P is 256. So you're talking about almost 2 points, a little less than 1% before you really have to be concerned. Because remember, look at the strength of this trend here. So that's really your key area, this sort of compression zone, even though you broke out to new highs, is the critical level, and then clearing that 10-day moving average, and that definitely comes in around 256. Okay, so now let's take a look at some of the key intermarket relationships here. And the first thing you're going to see is that the SPY versus utilities are definitely still overall in gear, right? But in fact, we've got a little bit of deterioration here on the monthly, right, where the SPY is a little bit weaker than utilities, and that's what's causing some of this deterioration in our gauges overall. And again, if we take a look at some of the other key ratios, it's really focused on high yield debt versus bonds. Bonds have been so strong, high yield debt not keeping up with it. So there's your core areas of deterioration. All right, now in terms of sectors, as you noted in my text of the the market commentary for the week, we've got some deterioration in the sectors, and that's now been going on for really 2 weeks. And when I say deterioration, we'd like to see real participation across the board. So as you can see here, basic materials down, industrials down for the week, healthcare down, home builders got hit the hardest, down 1.9%, transportation down 1.7%, consumer discretionary, which is usually the more speculative types of stocks, also got hit. That's definitely a cautionary sign. And of course, retail continues on its rip on the downside in actually a bearish phase. So, and then what's interesting is the thing that continues to lead: semiconductors, technology stocks. Those are the things that have been on fire. Strongest movement for the year. So there you go. Trend persistence. Follow the leaders. That has certainly been playing it out this year. But the thing to note, of course, here, the main thing is that there is not all around great participation in all of the sectors. In fact, 7 of the 14 we track are actually down for the week and underperforming the S&P 500. And the key, again, is that semiconductors and technology have been leading. The other thing to note is that energy, right here, up 2%. I had pointed out USO, crude oil, that's been definitely looking better. I'm going to show you a chart of that in a moment, and it looks like to be breaking out of a base. And it's interesting to see just if there's going to be an impact. I'm really not sure. To tell you the truth, I do think that what's happening in Saudi Arabia certainly is very, very interesting and could have an impact on this move here. My guess is it would more likely accelerate things to the upside, but that remains to be seen. So we're going to play this with a lot of flexibility and tight stops. We have current long positions in it, and the way we would play this is to continue with those positions, but put in tight stops. If you want to find out more about what we're doing and how we're doing it with Mish's Market Minute Advantage service. And if you want, you can certainly call Mary and find out more about it if you want to follow what we're doing there in the energy sector. Now, the other thing I had noted was that volume analysis showed that there was some real weakness in terms of the participation and the number of accumulation days, which you want to see in a more positive note, especially in the leading index. So one thing that's interesting to note is that, as you can see here, the NASDAQ 100, right, is of course the leading index, up 29+% for the year, and yet over the last couple of weeks only has one accumulation day. So you're definitely seeing a divergence between price action and some of the underlying things that are occurring. So let's take a look at a couple of other things here. Let's take a look at market sentiment. So taking a look here at our market sentiment chart, this is looking at VIX with some Bollinger Bands. Now on an absolute basis, cash VIX here, last it's trading at 9.10. Literally you can see it's touching the bottom of the Bollinger Band or really close. That's the lowest price it's been in over a decade, and certainly is also reflected on a shorter term basis with these Bollinger Bands. So over the last several months, volatility has definitely been trending down and even longer, but never hit super, super low extremes like it's hitting now. So in terms of sentiment, we're really hitting very, very frothy levels. That is definitely something to sit up and take notice. So the thing that you definitely want to do is, if in fact we start breaking down here under the 10-day moving average and that 256 level that I had pointed out earlier, you would definitely want to tighten up stops around that point or even get short, because you could definitely have an attack, at least a short-term correction on the current, an attack on the current bull trend. At least a short-term correction could be in the cards. So with this, it's frothy. You want price movement to confirm. The last thing I want to do is take a look at the oil chart. So taking a look at USO here, I had pointed out last week, for those that saw the video last week, and even in the text, that there was an interesting sort of head, right, and shoulders pattern. You got a shoulder here, potential head in this area, and sort of a shoulder here, and a breakout. And you had a follow-through move continuing. From a ratio basis, you can see that oil, right, U.S. oil fund here is definitely outperforming the S&P. So even with the up move in the market, in the S&P, the oil is outperforming, and this is our triple play indicator over here, where we're benchmarking oil versus the S&P. And as you can see, it's certainly the best it's done since the beginning of the summer here. So that's showing some pretty good strength. In terms of momentum, I also pointed that out. Our real motion indicators definitely gave you a heads up in this particular zone here, right around the 10 to 1020 level. We're up 10% from there in just a couple of weeks. So this is definitely looking in gear as well. So there you have it. You've got, again, a couple of things to be concerned about. You might be at a point of pretty frothy action. I've given you some key reference points or price levels to be aware of, and if you violate those, you could get a much more substantial short-term correction in the market. And again, oil looking like it's really strong and in play. It is still unclear what's happening in Saudi Arabia and how that might impact the market. But nonetheless, looking at pure price movement here, things definitely look in gear. Now, the last thing before I go is just let's take a look at the situation on the weekly charts. So one thing you can see here is on our weekly charts, we're also getting a breakout here in both price, right? Right now, we just moved over our 50-week moving average in the last couple of weeks. Momentum has clearly moved above our 200 week of real motion. And actually, again, for the first time in quite some time, we're also breaking out on a relative basis on a weekly basis or on the weekly charts as well with oil compared to the S&P. So that definitely looks like a play that has a lot more potential upside in in the cards here. All right, hope this helps. See you next week, and bye for now.